Hello and welcome to Market Domination. I'm Julie Hyman. That's Josh Lipton, live from our New York City headquarters. We're giving you the ultimate investing playbook to help tune out the noise and make the right moves for your money.
And here's your headline blitz, getting up to speed 1 hour before the closing bell rings on Wall Street.
At the same time that the Fed is going to restart its easing cycle and step down by 25 basis points, I think that's going to coincide with the time when maybe we get a trade deal in India and the EU. And that essentially means that we have trade deal done with almost 50% of the global economy, including the US. So a rate cut, progress on trade, and that really clears the skies ahead for equity investors and for economic growth alike.
What they're looking for is ideally a kind of a three-part boost to the economy that comes from the tax bill being done, more trade deals being announced, and decisions on reciprocal tariffs, all of which come around the first week of July 4, July 9. So they're looking at a big boost there. Beyond that, though, I think it's probably full speed ahead in Washington, and since the House and the Senate agree on the fundamentals of this legislation, they've got to spend a few weeks dealing with details, and they're probably done.
Really positive results. I mean, a couple of things happened. AI is doing a little bit better than people had anticipated, so that drove a little bit of upside in the quarter. But more importantly, some of the operational issues that hit them in the first and second quarters, they're starting to clean that up.
We got 1 hour to go until the market close. So taking a look at the major averages here, the Dow's actually heading back to negative right now, down just about 10 points, all 10 points at the moment. The S&P 500 hanging on to gains. All of the major averages have been kind of volatile within a range today. The NASDAQ up 0.5%. Two key data points this morning. We had the ADP jobs read, which economists kind of put some cold water on, but showed the smallest gain in 2 years. And you had ISM services, the services sector showing contraction, which was a surprise for many economists.
Yeah, I think ADP was interesting. It was well below consensus, and the pressure point there was really small business. I mean, that caught a lot of attention. Maybe not that surprising. I mean, those companies are just not going to have, Julie, obviously the scale and the flexibility like their bigger companies to pivot and change and adjustments. But ISM services, as you point out, also below consensus. Yeah. I just think investors are trying to make sense of it. Maybe also trying to figure out how the Fed makes sense of it.
Yes, exactly.
To the point that the idea that the extent that you get this softening data, but also coupled with inflation prints that have been relatively benign, what could that mean for cuts ahead?
Yeah, exactly. And so that's reflected in what we're seeing from the 10-year today, pulling back 9 basis points, pretty sizable move there, reflecting that lookout that, okay, maybe the Fed has a little bit more room to cut now, but of course it's all going to hinge on inflation and tariffs and when they start to bite. If you look at the groups that are on the move today, remember we talked about energy gaining the most for the past couple of days? That's not the case today. It's flip-flopping. It's going down today. Utilities also showing some weakness. Communication services and healthcare are what are rising on the upside. And we like to look at large cap tech here. Apple showing a little weakness today. Got a downgrade over at Needham that we're going to dig into later. Meta having another day of strength, and Broadcom once again on the rise.
With earnings on deck.
Yeah, and another record for the stock too.
Yeah, good for Octane. For more on the latest market moves, let's get to Tony Roth here, Willington Trust CIO. Willington Trust has over $79 billion in assets under management. Tony, it is good to see you. So talking there with Julie Howe, we did get that economic data today, Tony, and it was weaker than expected. ADP weaker, ISM services weaker. But stocks, Tony, I mean, the SPX is up today, albeit slightly. Just curious to get your take on the market moves.
Yeah, I think that the market is a little complacent right now, to be honest. The environment is one where there's continues to be a tremendous amount of macro uncertainty with respect to both tariffs and the degree of further debt load that the country is going to be taking on over the next decade due to the big, beautiful bill. And so the market at these valuations is not really pricing in negative outcomes for those issues, which are really defining issues of the next 6 to 12 months in the market. And so if you think that those issues are going to resolve to perfection, then I think these levels are justified. But if you think that the process of working through trade deals will take longer than July 7th, then I think you're going to see a pretty flat economy for the rest of the year. And if on top of that, We have a if you will, a spasm in the bond market because of the amount of debt that's being taken on. People walk away from long-term treasuries, and the long end of the curve, the 30-year point of the curve, is the place to see that happen, not really the 10-year, which is more tied to short-term inflation. Then that's also going to weigh on markets. So at the moment, markets are probably overextended, and it's not to say that we necessarily get a big correction from here, but I wouldn't be surprised to see one.
And so what do you think is a more appropriate level then for stocks right here that would sort of capture fair value better than where we're seeing them trade right now?
Yeah, it's a great question. We're a couple percent above below all-time highs. So 5 to 10% lower than I think where we are today would probably make a lot of sense. The other thing to keep in mind is that even if we do have the perfect outcome on tariffs and a reasonable outcome on the big beautiful bill, which would be to say the Senate takes at least a few hundred billion dollars out of the expected additional debt that the country takes on, we're not expecting to see growth really for the rest of the year. We're expecting to see a technical bump in growth in the second quarter as a result of the slowing of imports. And then in the third and the fourth quarters, a pretty flat overall real GDP picture. Maybe no growth at all, maybe even a slight contraction in the third and the fourth quarters. So that does not set up for a market environment that is overly appealing. Now, having said that, there are some drivers. I think that the reignition of the tech and the AI trade is interesting, and we believe that the Fed will start cutting probably in July. It may not be to September, but regardless, we see 100 basis points of cuts between now and the end of the year. But that's not going to be in the context of good growth. It's going to be in the context of weak growth, and those cuts will be driven largely by the third rail of growth really decelerating.
What about, Tony, that big, beautiful bill, the Trump budget bill, the tax bill? What could that mean in terms of stimulating the economy ahead?
So I think it depends more than anything on the amount of deficit that the bill takes on for the country over the 10 years. Because we're almost certain that there's going to be a front loading in the bill that favors companies from an expensing standpoint and that provides additional incremental tax relief for consumers, whether it be child tax credit, whether it be SALT relief, et cetera. So there's going to be some front loading of stimulus in the bill, but that will be more than offset by tightening of financial conditions if we see the spasm in the 30-year Treasury, because we move from let's call it a $3 trillion expected additional deficit or debt load for the country over that 10 years to only 2.9, let's say. I know that the Congressional Budget Office came out today with a number closer to $2.5 trillion. I wouldn't believe that number. The real number by all the truly independent quasi-governmental entities is more around $3 trillion right now. So if we get a smaller bill with the front loading, as I expect, regardless of the size of the bill, that could be very positive. But his history shows that these senators don't usually have a lot of courage, if you will, to push back on the president.
And so when you put all of these elements together, Tony, what are we looking at in terms of recession odds at this point? And what are the implications for stocks, which of course tend to usually predict the recession? So I don't know when that would put the time, if the correction you were talking about could potentially reflect that.
Yeah, so I would say 55% chance of recession. And I would say that as we approach July, one of the interesting features of the environment right now is the so-called taco trade, where the president has now been called out, in a sense, of backing off whenever we get to a point where the tariffs get so high that they risk imperiling the growth of the economy. And so if, in fact, that's going to have the opposite impact and cause the president to hold his ground with these higher tariffs in July, then that's going to be very problematic and cause those recession odds to shoot up pretty significantly. On the other hand, if somehow they get these trade frameworks done, whether they actually improve the terms of trade or whether they're just more window dressing in order for the administration to find an off-ramp here, is not important to the market. The point is that the market needs to see any alternative other than significantly higher tariffs than the average of 10%. So that's sort of that balance that is trying to sort of work itself through as we approach these critical dates in the beginning of July.
Tony, on the Trump tariffs, the president did make some news there today. He was posting on social media this morning saying he likes Xi, but saying very tough to make a deal with. So sounding a bit frustrated there, perhaps. I'm just wondering, as a CIO, Tony, when you see those social media posts, they certainly get attention, they make headlines. How do you try as a CIO to think through them? How do you navigate that dynamic?
Well, it's very tough because we have an economic-led investment process, which means that we think about where the economy is headed, and if the market is not fairly valuing prospects for the economy, then it's an opportunity to take advantage of that disconnect. Right now, such a disconnect would seemingly exist, namely that the market is pricing in a better outcome than what we are forecasting for the economy in a scenario-weighted set of probabilities. The reason that we're not underweight, though, risk is because right now, we think that there is, again, this taco trade. The president has shown himself to be fairly reactive to prospects for economic growth, which would suggest that tariffs are not going to come back in as strongly as they might if he was more resolute, in a sense. So that's one thing. And then on top of that, we have, as we've talked about, the potential stimulus from the bill in the short term, which is going to be front-end loaded. We have significant monetary stimulus coming. And so even though we expect to see that recession in the second half of the year, it will be a mild recession. And it's entirely possible that the market looks through that recession to the growth that we expect will then ultimately come in 2026, in the first quarter of 2026. So as longer-term investors, to try to time that possible drawdown in front of the recession is really tricky and probably too cute for us. And that's why we haven't moved to underweight right now.
Tony, good to see you. Thanks so much for joining us.
Yeah, thanks for having me.
Thanks. Just getting started here on Market Domination. Coming up, we'll be joined by the CEO of Tractor Supply to discuss all things from the latest stock moves to egg prices and even chick days. What are chick days, you might ask? We'll tell you. Plus, in the 4 p.m. hour, HPE CEO Antonio Neri, we'll hear from him to break down the latest earnings and the path ahead for the company. Stick around, much more Market Domination still to come.
The Federal Reserve pointing out in its Beige Book a slight decline in U.S. economic activity, and Yahoo Finance's Jennifer Schonberger joining us now with the very latest. Jen.
Hey Josh, that's right. The economy has declined slightly since April, while prices increased and could continue increasing, according to the Federal Reserve's Beige Book, which is essentially a compilation of anecdotal evidence across the Federal Reserve's 12 bank districts. According to the report, households and businesses are taking a cautious approach to decision-making amid policy uncertainty. Consumer spending either holding steady or dropping over the period, though there was some front-loading ahead of the tariffs. When it comes to the job market, that really hasn't changed much since April. Uncertainty about policy is delaying hiring, however. In general, many businesses see more applicants for open positions, but aren't looking to hire much at the moment. There are hiring pauses and plans for staff reductions, and while there were some layoffs in certain sectors, it certainly was not pervasive. Now, on the inflation front, prices increased moderately since April. Looking ahead, many businesses expect costs and prices to rise at a faster rate as higher tariffs are pushing up costs and prices. But the responses to the increase in costs are expected to vary across businesses, with some passing all or part of that cost on, while others are just going to take the hit to profits, and while still others are looking at adding temporary fees or surcharges. And for those who are looking to pass on those price increases, they expect to do it in the next 3 months. Now, the Federal Reserve will use this information at their interest rate meeting in 2 weeks. The central bank straddling both sides of its dual mandate to maintain full employment and price stability. Nearly all members of the Fed are eyeing a risk that inflation from tariffs could prove longer lasting rather than a one-time increase in prices. Officials also looking carefully for any cracks in the job market. Of course, today we got that ADP report that did show a drop. However, all eyes are on Friday's government jobs report for the real latest litmus test on the job market. And guys, really, Fed officials are aware that given that they've been holding interest rates at these moderately restrictive levels, they're expecting to see a gradual cooling in the job market. Back to you.
Jen, thanks very much. Weak consumer sentiment and trade policy uncertainty weighing down hiring. Private payroll additions slowing in May, increasing by 37,000 jobs, less than the 114,000 jobs estimated, down from the previous month. This is specifically according to ADP. Of course, we will get the non-farm payrolls numbers from the Bureau of Labor Statistics come Friday. For more on how we should be reading all of these jobs numbers, RBC Capital Markets economist Carrie Freestone is joining us right now. Carrie, it's good to see you.
Thanks for having me.
So we got ADP this morning. It showed that 37,000 job gain. I believe the consensus estimate at last check for Friday was 126,000. These numbers don't always match. In fact, they frequently don't match at all. I know this is something you've been looking at. How should we be thinking about ADP?
So honestly, we don't give a ton of weight to ADP, and we don't think the Fed will either. There's been a significant divergence between how the ADP has performed and how the payroll numbers have performed in recent months, and the correlation has significantly weakened over the past 11 months. So we think the Fed is going to be most focused on the payrolls data that we get on Friday. And in our view, we're expecting a pretty status quo payrolls number, which is somewhat surprising, I guess, to be saying this, considering the fact that the macro backdrop is anything but status quo right now.
And then, Carrie, after Friday, how do you actually see the labor market sort of evolving over 2025? Because there's plenty of economists who are saying, look out, we're going to see some real weakening over the quarters.
So I definitely do expect to see some weakness, but it's going to take some time for the situation to evolve. And obviously that's contingent on the outlook of trade policy, which remains significantly uncertain. But even though we don't know what's happening, we're in a situation now where businesses are facing a level of paralysis. Nobody's wanting to ramp up hiring when they don't know what's going to happen down the line. So in many cases, we've seen hiring freezes. Having said that, even though we expect to see some layoffs, specifically in the goods sector down the road, we have some demographic forces that are going to put a cap on how high the unemployment rate can rise. So our expectation, we think on Friday, it's going to hold steady at 4.2%. And, we could see it drifting higher to 4.7 by early next year. But that's not that high from an historical perspective. And the reason for that is we have significant levels of retirements coming through. And so as retirees vacate positions, we're going to see, a shifting in the labor market, and we're going to see some positions that need to be filled. So, of course, while that doesn't, add to jobs created in the overall economy, what it does do is it means that the unemployment rate isn't going to rise as much as it otherwise would.
And so all of this is interesting because it doesn't sound like that negative of a scenario. You had, of course, President Trump tweeting this morning also about the ADP number, and once again calling on Fed Chair Jay Powell to cut rates. Now, as an economist, if you're not seeing a lot of weakness coming in the jobs market, that doesn't necessarily allow the Fed to cut rates, or how does that feed into the whole equation?
Yeah, so the Fed is in a difficult position, but one thing I will say is that if history is any indication of what's going to happen, the Fed seems to be more sympathetic towards the labor side of the mandate. So we know that, if we start to see an erosion in the labor market, if we see the unemployment rate tick up by 0.4 or 0.5, that should likely be enough for the Fed to cut rates. Now, we don't expect anything this month. In order for the Fed to move towards a more neutral Fed funds rate, we're going to have the data allow the Fed to be in that position to cut, and we just don't think they're there yet. Especially, if we look at the inflation data, we're still, core inflation's at 2.8%, quite a bit away from that 2% target. And on top of that, the labor market isn't really looking that weak just yet, although we'll have to see what happens on Friday. But we really think that, it's going to take a few months before the Fed is in a position to cut. Our expectation is likely this fall, but we're going to have to see what the data shows.
Are we going to see some kind of terrorist-induced jumps in inflation carry ahead, do you think? And would those be one time? Would they be persistent? How would you think about them?
So, I mean, right now we're really in limbo because we have the 90-day pause and we have a bit of a buffer with this negotiating period with China. But, you know, it's realistic to expect that inflation is going to tick higher, likely above 3%. And, you know, now that we have those 50% steel and aluminum tariffs, you know, it could be even towards 3.5%, depending if those stick. So definitely going to be upward pressure on prices. That's going to be concentrated in core goods. And that is ultimately going to weigh on consumers unless businesses have sufficient profit margins to absorb those costs. And as we saw this morning in the services PMIs, some of the businesses stated, you know, we really are going to have to pass those costs off to consumers because we don't have sufficient buffer to absorb those.
I want to ask a question about inflation data because there was an interesting story in the Wall Street Journal today that pointed out that the Bureau of Labor Statistics, which compiles inflation data, has been cutting staff. And part of the process of getting the data is having people get on the phones and saying, what are your prices, and doing price surveys. And so, according to the article, some economists are concerned about the quality of the data that we're going to be getting from the government. Are you concerned, first? And secondly, does this then increase the need for sort of those alternative inflation sources?
So I would say as of right now, I'm not concerned about the quality of the CPI data, and I think that that is a survey that they would prioritize. But certainly if we see labor market cuts and we see cuts from the federal government, that there could be a concern with some surveys that are maybe in the peripherals. But as of right now, you know, I'm not necessarily concerned about the quality of data from CPI. I trust it, and it's going to be something that I'm monitoring quite closely.
Okay, Carrie, thanks so much. Appreciate it.
Thanks again.
Let's move now to our trending tickers of the day. We're watching Amazon and Guidewire, both on the up and up. Apple, on the flip side, seeing some losses. Let's start with Amazon. The company seeing some small gains today following an expansion announcement. Amazon said it's going to be investing $10 billion into North Carolina for its cloud and artificial intelligence infrastructure. And the shares are up about 1% today, but really this is sort of part of the company's strategy that's been announced to spend about $100 billion overall this year on building out AI infrastructure.
Yeah, it sounds like this investment will create at least 500 new jobs, expected to support thousands of local construction jobs. The governor here is saying this investment among the largest in the state's history. By the way, Dan Ives over at Wedbush, out with a fresh note this morning, identified the 30 tech companies he believes will define the future of the AI theme over the coming years. Yes, obviously, NVIDIA, Dan's going to put in there, but Amazon as well. Makes the cut.
And there's a new Ives ETF, apparently, that has that in there. This is not the first investment, by the way, that Amazon's made in the South. It's announced plans back in January to invest at least $11 billion in Georgia. So this is something that it, and of course its hyperscaler competitors, are also doing.
For sure.
Yeah.
Let's look at Guidewire as well, because it's also saying share increases today, on track for a record close here, in fact, after the software maker announced a rise in sales in their third quarter, pointing to a large adoption of the cloud-based platforms by customers. Despite falling short of market expectations for revenue, companies still saw big gains in the stock market during trading hours. So this one comes out, it boosts its revenue guidance for the year, and that did exceed what the street was looking for. So they now see between, it looks like, 1.18 and 1.19 billion. The estimate was close to 1.17. Company saying based on this strong execution and our robust pipeline, we're raising our full year fiscal 2025 targets, Julie.
And this stock, which, to be frank, I hadn't heard a lot about before today, kind of flew under the radar.
Yeah, sure.
But it's on track for a record close today. It's up 50% this year. It's more than doubled, up about 130% over the past 12 months. So it's done really, really well. Analysts here seem to like it, although many of them now have neutral equivalent ratings on it after that huge increase that we've seen in the stock. But most of the chatter I saw, commentary, was positive on these numbers, at least.
Yeah, investors have been very positive.
Yeah. And let's talk about Apple now. Major fluctuations in that share price today, although in a relatively narrow range. Needham, Laura Martin over there, leading those analysts to raise, or to cut the stock, I should say, to hold from buy, citing overvaluation and growing artificial intelligence competition. The stock was higher to start the day, but now it's just about flat. What I also thought was interesting, she said, what would change my mind on this? And she said, for the stock to work, it must have the catalyst of an iPhone replacement cycle. She said, we don't see that coming in the next year.
I am not totally surprised by this, only because we've had Laura Martin on this very show, and she was like the least bullish Apple bull I think I've spoken to in a while. So this didn't exactly shock me that Laura would come out, take the red pen, downgrade this one. It does come after this stock has already taken a beating. I mean, Apple's down about 20% this year already. I wonder how much of the bad news she's highlighting is already reflected. She clearly thinks more to come, or not reflected enough.
What does she like better? Alphabet and Amazon.
There you go.
So sharing some Ives preferences there.
Yes. We're going to stick with Apple here because it is kicking off its Worldwide Developers Conference on Monday. Pivotal moment for Apple as it competes in the AI race. For more, we're bringing in Yahoo Finance tech editor Dan Howley. Dan, of course, this is the show where they get up there, it's Tim Cook, it's Craig Federighi himself, and you're talking to millions of developers, and you're trying to convince them, hey, you want to build in the Apple ecosystem.
Yeah, I mean, and that's generally what they do. I think this year the expectations are more subdued than in prior years, just because last year they had their huge AI rollout. It hasn't been going so hot for them. Siri obviously was put on the back burner. Now we're waiting to see when that's able to come out. So we're still going to get some good announcements this year, but not necessarily the big wowee that we got last year. For this year to just kind of prove what they're able to do in the AI race, they have to just show that they can compete, that they aren't an also-ran anymore. Obviously, we have Google. They had their I/O developer conference. Microsoft, they had their Build developer conference. Both of them rolling out these big AI functions that are getting consumers and enterprises excited. What does Apple have there? They also just give us an idea when Siri's coming, man. Like, I know that they said later this year, sometime this year, but this was really the marquee piece of WWDC 2024. They showed off some of the great examples of how this could be used. One of them was, say your mom's landing, flight's landing. When should you leave, or when do you expect the flight to land? Well, you'll ask Siri, it'll go into your email or your messages, find out what time the flight was expected to land, and then cross-reference that with flight tracking information and say, okay, the flight's expected to land blank.
That sounds great.
Sounds awesome. Not there yet. So we're going to have to see where that is. By the way, that's the idea of agentic AI, and that's kind of where Microsoft's heading, where Google's heading. We have to see if Apple's able to do that. And then the other thing is, are they making their AI worthwhile for developers to build on? Now, there's been reports from Bloomberg's Mark Gurman basically saying that they're going to open up some of their own language models, their smaller language models that they use on device developers, so that they'll be able to then build on Apple's own language models. We'll see if that ends up kind of goosing any kind of new type of app capability. The idea here is, think about what happened with the App Store. They opened up the App Store. We have a whole ecosystem of products now, right? I mean, Uber's, you're not taking Ubers without the App Store, right? I'm not saying that that's going to be on this level, but that's the idea, is you open it up to developers and then they just start to go wild, and then perhaps that really starts to send Apple's AI capabilities, into outer space, right? So that's the idea there. Everything kicks off on June 9th, and it'll be at their headquarters. I'll be there.
Awesome.
That's a great look, by the way.
Let us talk about another side of AI, and that is the licensing and training side, because there's a story out today that Reddit is suing Anthropic. It has to do about the use of its data. And this is really interesting because one of Reddit's revenue sources is licensing its data to train AIs. But I guess it says Anthropic wasn't supposed to be doing it.
Yeah, I mean, this is something that, unless there's some rule put in place, some kind of blanket regulation or agreement across the industry that's going to continue to rear its head, right? We had the New York Times obviously suing OpenAI, but then they're also working with AI companies. So, it's this constant back and forth of, can you train data without asking for the owner of that data for permission? And so the larger thinking is that AI companies just went ahead and did that overall, and now that there's backlash, now they have to figure out who they can work with and who they can't work with. Reddit is a huge repository of knowledge, right? You have Not that it's
Not all of it's accurate.
Yeah, no, don't get me wrong. Look, you can go on Reddit to find out how to change your tires, but you can't go on there to figure out, I don't know, advanced math. Or maybe you can. I don't know. I'm not using it for that. Bird IDs are great on there, but it's a huge repository for data. For AI companies to then have access to that, to train on, is massive. So you understand why they want access to it, but you can't just go in someone's house without knocking first. You know what I'm saying?
By the way, Merlin for bird IDs.
Yes, excellent. I'm looking for a painted bunting.
Oh.
Beautiful birds.
Okay.
Yeah,
Learn
let's look
something
them up.
every new with Hallie. Always something new. Thank you, Dan. Coming up, we're joined by the CEO of Tractor Supply Company to discuss all things from the stock moves to egg prices and even chick days. Stick around, much more market domination. That's still to come.
Warner Brothers Discovery hosting an annual investor meeting this week, and shareholders have voted to reject the 2024 compensation packages of its top executives, including CEO David Zaslav. Joining us now to discuss Yahoo Finance's Allie Canal. You don't get this happening terribly often.
Yeah, don't get this happening often, and very interesting results to see such a wide majority reject this pay package. Now, it is important to note, even though shareholders did ultimately reject this, the decision is non-binding. That means the $51.9 million that David Zaslav made last year still stands. So this vote is largely symbolic, but the message was certainly clear. More than 1 billion votes cast in opposition. The final tally broke down roughly 60-40 against the pay package, and that's a shift from last year when the proposal barely passed with about 53% support. Now, in response, the company's board said it, quote, takes the results seriously and plans to continue constructive dialogue with shareholders. The vote followed a recommendation from proxy advisory firm ISS, which urged investors to reject the plan, pointing to pay-for-performance misalignment and inadequate responsiveness. And it comes as Warner Brothers Discovery stock, well, that struggled in the aftermath of its 2022 merger. Like many in the industry, the company has been hit hard as consumers cut the cord, move away from traditional cable. Earlier this month, S&P Global downgraded Warner's debt to junk status, citing ongoing struggles in its cable network division. To that point, legacy brands like CNN, Discovery, they've taken a hit with both ratings and ad revenue on the decline. And while its streaming service is profitable and adding subscribers, it still trails behind giants like Netflix and Disney+. Despite all of that, though, Zaslav pay remains in line with, and even in some cases, exceeds what rival media CEOs are making. And as you can see on your screen, Netflix co-CEO Ted Sarandos, he made $61.9 million last year. Greg Peters pulled in $60.3 million. Disney's Bob Iger earned $41.1 million, and Comcast CEO Brian Roberts came in at $33.9 million. So again, while this vote mostly symbolic, it reflects growing scrutiny across the industry, and we have seen real changes come out of similar results. Just last year, for example, Netflix overhauled its executive pay structure after shareholders pushed back. So we'll see if we continue to track this and get any changes out of the pay. But again, we'll have to wait and see.
Allie, thanks so much. Appreciate it. Well, Tractor Supply made a name for itself during the pandemic as people migrated out of cities, and many of them started little gardens, they got new kinds of pets, and they went to Tractor Supply. Since then, we have seen the growth of the company be a little bit more choppy, as has been the stock. But let's talk about what's ahead for Tractor Supply. We've got the CEO here, Hal Lawton, with us here in the studio. Hal, thanks for being here.
Thanks for having me on.
So, as I said, you guys saw sort of that big pandemic boost, and now you're in sort of a normalization phase, it seems like. Last quarter in particular, I know that you saw some weakness in big ticket purchases on the part of your customers. I'm curious what you're seeing now. Give us a sort of read on your customers and their spending trends at the moment.
Yeah, I'd start by, if I look back over the last 5 years, to your point, we've basically doubled the size of our business. I think different than a lot of retailers, we've not given back any of those gains that we've had over the last 5 years. And also our growth was really almost 50-50 balance between ticket and also transactions. Over the last 18 months, as you said, we've kind of been a bit more stable. our ticket has really been what's been under pressure, with our transactions, the footsteps in our stores continuing to still be strong. And that's really because the goods that we sell have been kind of normal in pricing, or even a little bit deflated, kind of counter to what's going on in the rest of the United States, where we've had a lot of inflation in the country, which has really been service driven, as we all know, with things like rent and insurance and hospitality costs and those sorts of things. But actually, goods over the last 18 months have been flat to actually down,
and particularly
in pricing.
Feed, which is a big part of what you
exactly,
sell.
Feed and food. If you look at Q1, two things on the ticket were really the drivers of our business that quarter, but also are the ones that are giving us kind of optimism as we look ahead. The first would be on our core commodities and kind of the deflation that was lingering still in Q1. We've talked about, as we get into Q2 and exit Q2, that we see that switching to inflation after having cycled 18, 24 months of kind of lower commodity prices. And we still feel we're still seeing that in the business, and that's still very much on track. To your point on big ticket, we struggled a bit with big ticket in March in particular because it was a delayed spring, and that's really when, like, riding lawnmowers and recreational vehicles and trailers, all of which are big businesses for us. We're the largest seller in the United States on all three of those goods. It was a softer start there, and then that continued into April, again, because it was a cooler, wetter start to spring. But when the sun's out, those businesses have been strong. It was a nice May. So far, it's shaping up, early in June, but we're a week and a half into our fiscal June, and it's been a nice sunny early of June as well. And the moisture that's been in the ground over the last 6-8 weeks continues to help drive those big ticket sales as well. So seeing a bit of a normalization as we would have expected here in the second quarter, and what we talked about is our expectation on our earnings call. More broadly, the consumer, I think consumer continues to be stable and strong. I don't think the consumer's much different than it was a year or even 2 years ago. Still cautious in times, but also kind of tapping into pent-up savings, tapping into their HELOCs. Wages continue to be strong and outpacing inflation. And so, I think consumers, while they continue to show kind of their wariness and kind of their surveys, I think their actual spending continues to remain pretty stable.
What about how tariffs? What's your exposure there? How are you navigating that? Are you eating that? Are you passing that along? Some combination of the two?
First off, I'd say our exposure to tariff is less than the vast majority of retail. It's not a existential issue for us, like it might be, particularly if you're on the soft line side and have a majority of your goods are purchased outside the United States. Over 60% of our goods are produced or manufactured in the United States. Think about things like animal feed and dog food, bird seed, those sorts of things, those core consumables that are our staples, right? Kind of our grocery store equivalent. And those aren't really, don't have significant tariff exposure. Our tariff exposure is really more on the hard lines and soft line side of our business. We estimate around 20% of our goods, both direct imported plus through our vendor providers, comes from China, and about another 20% from outside of China. But we just dusted off our playbook from the 2018-19 perspective. We just you go through a series of actions. You first negotiate with the manufacturers you have to try to offset some of the costs that might come along with tariffs. You'll look to diversify alternative sources. You'll also re-engineer your product. You'll of course look at pricing at times too, and you kind of pull out all those sorts of toolkits and navigate through it. And of course, we just kind of follow along with the news that's evolving on a daily basis, and are navigating our business accordingly. But again, not an existential issue for Tractor Supply, and one the team's doing a nice job of navigating.
Where are you in the toolkit on the pricing piece of it? Have you been raising prices, not on things like you mentioned that are made in the U.S., but those imported items, or have you gotten to that point yet? And when do you think, timeline-wise or time range, you think you would get there?
I'd start with, we approach our business in a portfolio strategy, and we'll look across our business to find ways to offset any pressures that come as it relates to tariffs. On pricing, we have seen some modest moves in the marketplace. I would say starting with the MAP-based products. These are products where our manufacturers have suggested retail pricing out there. They kind of dictate that pricing. Many of those manufacturers are already on their second MAP update, And in those categories, pricing has moved really across the board and across the industry. And I think those are the ones that have moved so far. I think on the import side, you've not yet seen that flow through, the direct import side. And certainly where folks are going to see a lot of the inflation is going to be on the seasonal programs that come in the back half of the year, things like Halloween, Christmas, and others. That's where I think we'll see a significant amount of tariff inflation flow through.
Hal, talk to me about the competitive landscape, what you see and how it's evolving. Because I was talking to an analyst who covers you all this morning. He was emphasizing how he said Amazon and Lowe's, he mentioned how they're kind of moving harder into those rural areas.
Yeah, to start with, we don't have a direct national head-to-head competitor, and so oftentimes I think folks are looking to try to size us up versus someone. If you think about Walmart, Target, back in the day, Best Buy, Circuit City, Home Depot, Lowe's, kind of pick your section of retail. We don't have one of those direct head-to-heads. We compete against, tens of thousands of different retail locations, like we were talking about before coming on, like the Agways of the world and the local co-ops of the world, but also against the pet specialty stores, certainly against mass merchandise and against home improvement. I've been in the company now nearly 6 years. I'd say over my 6 years, there's been more than a handful of companies that each have made more than one announcement about activities they're, strategies they're pursuing in rural America. And, for us, we just continue to focus on our business. We've been around for 87 years. We're looking to build a business for the next 87 and just execute our strategy and stay focused on Tractor Supply. And, we continue to take share in the market and, continue to grow our business in spite of some of these announcements that others have made.
Hal, something else you all made headlines for, and this was almost 1 year ago now, you all kind of rolled back on some of your corporate diversity efforts. This was following, at least in part, some social media pressure on the company. And I'm just curious, how you think about how you approach those issues now, issues that, on the face of it, in some cases, seem to be moral or even business best practice issues that have turned into more politically divisive issues. Are you sort of more careful about how you wade into those things? What are some of the lessons you learned?
I'd start, again, as I said earlier, about our age. We're an 87-year-old business. Our mission and values and our culture are sacrosanct to Tractor Supply, and I would put our culture against any company in America. We live and breathe our mission and values. We talk about them daily. We kind of live up to our culture. When we went through our moment last year, our goal was exactly as you said. We wanted to remove ourselves from any sort of discourse that people viewed to be political or social in its orientation. We wanted to remove ourselves from that. There were some of those perspectives that we're picking sides. That was not the case at all. We were actually wanted to remove ourselves from the conversation. And we really haven't engaged in the discussions since then on this topic. At the end of the day, I think actuals are what really matter. And if you look last year in our business, we had our lowest turnover ever in our frontline team members, and we had our highest customer satisfaction scores ever. So for Tractor, it was all about just maintaining our focus on the stakeholders inside of our business that matter the most, making sure everyone knows that we're a respectful place that people can shop and work, and make sure that we're the same Tractor they knew 5 years ago and 10 years ago and that they knew last week. And again, it was all about just removing ourselves from that divisiveness and that where people had perceptions that companies were taking political and social agendas and taking perspectives on that. And we want to do business with all customers, and we're not looking to take sides.
Would you still say, in terms of hiring, that diversity is something that's important to the company in terms of the complexion of your workforce, both in the stores and in the executive suite?
Absolutely. We embrace the topic of diversity. As we know, whether it's diversity in background, whether it's diversity in ethnicity, it makes a business better when you have all sorts of points of views inside the business. And what we really did was just remove our external metrics as it related to that topic. But internally, we continue to be respectful of all of individuals and continue to embrace the notion of diversity inside of our business. And if you look at our metrics, we had internally, we had improvements in all those areas last year.
I want to sneak in one much less controversial question to you, and that's about baby chickens.
Yes.
I think that's something everybody can agree on. You guys have these Chick Days promotions where you're selling baby chicks. We've talked about eggs a lot. Everybody's talking about eggs a lot in terms of the price. What have you guys seen in terms of demand for those chicks, this year compared to last year, the last few years because of that?
Yeah, I'd start by just saying more broadly on it. chickens are really becoming the third pet in the backyard. Nearly 1 in 5 of our customers, and we have 40-ish million customers, nearly 1 in 5 of our customers raises chickens now. And that's been growing over the last handful of years. And we, as you know, we sell live birds in our stores. We've got a huge poultry department in our stores. We sell chicken coops. We sell all things you need to raise chickens and care for your chickens. This year has been another record year for us. We'll sell a record number of live birds. We'll sell a record number of poultry feed. We'll sell a record number of coops. It is a big year as well. I think part of it's just the overall wave that's occurring in that category and in that animal species. And then some of it was also driven by the concern of egg prices and folks just kind of getting into the category. But even as egg prices have come down, we've not seen any slowing down in the category and in the business.
Chickens are the third pet.
Yeah,
Who
absolutely.
knew? Hal, thank you so much.
Thank you so
really
much for having me
appreciate
on.
it. Thanks for coming in. Well, switching to another sector of retail, Dollar Tree reporting earnings this morning, beating on the top and bottom line, but the stock is sinking. The discount store warning investors that its second quarter profit could be down as much as 50% from a year earlier due to tariffs. It's a theme we've been seeing across the sector this earnings season. We're navigating how to find value among value retailers with the Yahoo Finance playbook. Joining us now is Arun Sundaram, a senior equity research analyst at CFRA Research. Arun, thank you so much for being with us. It's good to see you. Let's start with Dollar Tree there, and I guess perhaps contrasted versus Dollar General, which made a very different, had a very different earnings report related to tariffs, its commentary around tariffs. So tell us what's going on with those two.
Yeah. I think, overall, the past 2 days, both companies had pretty solid earnings. Q1 results were generally solid for both Dollar General and Dollar Tree. We got a positive surprise from Dollar General where they raised their full year sales and EPS outlook. In this quarter, actually, we haven't seen many retailers raise their outlook given all the tariff uncertainties. But Dollar General was an exception here, and they did raise their full year sales and EPS outlook. For Dollar Tree, they had a solid quarter as well, but they did call out that Q2 is going to be a exceptionally soft quarter, and a lot of that has to do with the fact that they did buy inventory from China when tariffs were 145%. So they have to work through that inventory in Q2. And that's going to hurt margins. But the expectation is by Q3 and Q4 of this year, they'll bounce back, and they're still expecting to hit their full year earnings outlook. So they really haven't. Dollar Tree did raise their EPS outlook for the full year, but that was mostly due to share repurchases more than really any fundamental change.
And so, Arun, you got a hold on Dollar General and Dollar Tree. Let's talk about one you have a buy on, and that would be Walmart. How come, Arun? How come you tell clients this one's a buy, this one's moving higher?
Yeah, I mean, there's a lot of good things to say about Walmart right now. Walmart's a much more diversified company. They have a large presence in the U.S. They own a club business, Sam's Club. They also have a very large international presence. Right now, I think Walmart is taking market share from most retailers, especially in the general merchandise space. Walmart, we think, is gaining more of those higher income households. Why? Because they have a pretty robust subscription program, Walmart Plus, and that's pairing really nicely with their growing e-commerce business. And really, Walmart's been kind of taking a page from Amazon's playbook, and it's working out for them. And another thing that we like about Walmart is that they're growing these new revenue streams at Walmart. Things like advertising revenue, third-party fulfillment services. Those revenue streams are much higher margin revenue streams, and it allows Walmart to reinvest in the business in areas like lowering prices for its customers or increasing wages for its employees. So they can really reward shareholders as well as their customers as well. So we do see Walmart expanding their operating margins over the next few years. And when you're a company with $500 billion plus in revenue, that every basis point of operating margin expansion translates into to pretty decent earnings growth.
Arun, again, maybe instructive here to sort of compare and contrast. You mentioned Sam's Club that Walmart owns. Then you also have BJ's that, of course, trades as a standalone. You have Costco that trades as a standalone in terms of those warehouse clubs. So among value retailers, how do you think about those three and where investors maybe should be looking?
Yeah, I mean, we really like the entire club channel. We have a buy rating on BJ's Wholesale. We have a buy rating on Costco. and we have a buy rating on Walmart, who owns Sam's Club. And all three of those club stores are a little bit differentiated. BJ's is, they focus more on in the grocery space. In fact, if you ask BJ's, they would probably say their number one competitor are traditional supermarkets, not necessarily Costco or Sam's Club, because they don't, they focus more on that in the grocery space and in smaller pack sizes. And then you have Costco, which really is kind of dominating the club space with industry-leading, growth. They're more exposed to more of that, affluent, higher income customer. They're growing their membership well. And then you have Sam's Club as well, who's also, growing their membership. I think a lot right now, this generation, a lot of millennials are going to that club model, especially as, millennials get married and have kids. So I think that club channel has a lot of room for growth over the next, several years. We see all three retailers, Costco, BJ's, and Sam's Club, all expanding their footprint across the United States over the next several years.
Arun, always good to see you. Appreciate that your time and those picks. Thank you.
Thank you.
While we're wrapping up today's Market Domination, don't go anywhere. We've got you covered with all the action following the closing bell. Stay tuned for Market Domination Overtime.